So, common crypto tax planning strategies. There are quite a few of them. And we are going to look at 6 strategies in this webinar, including 1, hold crypto assets for long term. 2, select and change cost basis allocation method the right way. And 3, utilize tax loss harvesting to offset capital gains. 4, to take advantage of the wash sell rule for crypto. 5, donate crypto to charity. And number 6 is use self-directed IRA account to invest in crypto. All right. Number 1, holding long-term, hold crypto asset for long-term. What does that mean? So holding an investment asset, including crypto, for over 12 months, which is considered long-term, has several advantages. So for example, long-term holding usually produces better returns when compared to short-term trades, especially for just regular investors who don't have the professional knowledge about trading. Also, long-term holding requires less transaction fees when compared to frequent short-term trades. It also helps to earn bigger returns from stakings, etc., due to the longer time frame. But from a tax planning perspective, long-term capital gains are taxed at a lower tax rate than short-term capital gains, which are taxed at the same rate as ordinary income, so which is usually higher. The one strategy many people overlooked is the selection of cost basis allocation method. Based on the IRS guidance, crypto investors can use either first in, first out, which is FIFO, or a specific identification method for cost basis allocation regarding crypto trades. From a tax planning perspective, we want to minimize gains to save taxes, but we may or may not want to maximize losses because every taxpayer can only deduct up to $3,000 of net capital loss every year. There are some confusions about whether change of cost basis allocation method from one year to another is allowed, and if yes, whether approval for change in accounting method is required. So we did some research, and based on our research, we can't find any law prohibiting the change of allocation method. Also, such a change is not included in the list of accounting method changes that require the IRS approval. So, in other words, you can change the cost basis allocation method from year to year on your own without having to apply for any approval. If you are using crypto tax software, make sure the software is able to lock the tax report for each year and use the correct beginning cost basis for each new year. Otherwise, the result after a method change will not be correct because the software will use the same method for all the prior years as well if it does not have that lock feature. So this is something very important. All right, the next strategy is tax loss harvesting, meaning an investor purposefully generates capital losses to offset their capital gains from the same or other kind of investment. This is a common strategy for both traditional and crypto investments. And this strategy has been advertised by, I would say, most crypto tax software companies as almost like a silver bullet for saving crypto taxes. Probably because the volatility of crypto prices creates more opportunities than traditional investment, such as stocks, for investors to harvest capital losses. When planning for loss harvesting, it is important to know which tax lot is most suitable to be used if you are using specific identification method. Also, to make sure to set the correct cost basis allocation method for generating the result if you are using crypto tax software to do it, because it does matter. The cost basis allocation method will impact the calculation of the result from loss harvesting. One last tip is you may want to generate short-term rather than long-term losses for doing loss harvesting so that you can preserve long-term capital gain. Okay, sorry. This is just a pool suddenly pop up, so I'm going to just get rid of that. So that you can preserve long-term capital gains down the road. All right. Okay. Another strategy people talk about a lot is the wash sell rule for crypto. The wash sell rule prohibits the recognition of capital loss from trading securities if you buy back substantially the same asset within 30 days before or after selling it. As you know, the IRS categorizes crypto as property for tax purposes. So currently, the wash sell rule doesn't apply to crypto, meaning you can sell one crypto and buy it back immediately and recognize the capital loss without actually suffering a loss, because you still end up with the same asset and your out-of-pocket cost of investment is still about the same as before. However, lawmakers have been wanting to close this loophole for quite some time. We believe change is on the way, and the time for taking advantage of this loophole is running out. Many people see the wash sell rule as the same as tax loss harvesting. I would say they go hand in hand, but they are not exactly the same, because you can do tax loss harvesting without triggering the wash sell rule. So they are not exactly the same. People usually utilize the wash sell rule loophole for crypto or tax loss harvesting in general near the end of year, when they have a good idea about how much capital gains they need to use losses to offset. There's no point in generating too much loss because, just like I mentioned earlier, each year you can only deduct up to $3,000 of net capital loss. One downside of utilizing the wash sell rule for crypto is you will end up resetting the holding period. If you sell an asset and buy it back later, that means your chance of getting a long-term capital gain tax treatment when you dispose the asset down the road is smaller, because now you have a shorter holding period. Also, due to the rapid change in crypto pricing, you may end up with an actual loss if you have a delay in buying it back after you sold it because the price could decrease a lot. That now you have a situation that you cannot get back the same cost basis like before. All right, so the next tax planning strategy I'm going to talk about is donate crypto to charity. This is a pretty popular strategy. Unlike selling or spending crypto to purchase products or services, donating crypto to charity is not a taxable event, meaning you do not need to recognize or pay taxes on any capital gains. If the fair market value of crypto at the time of your donation is higher than your cost basis in the crypto, you don't need to report any gain associated with your donation. In addition, if your holding period in the crypto is more than 12 months, you can deduct the fair market value of your crypto rather than your cost basis as charitable contribution deduction on your tax return if you are able to utilize the deduction. Some people consider this as a double dip because not only you don't need to report any capital gains on the increase in your crypto value when you donate it, you can also get a tax deduction at the fair market value, which is higher than your cost basis. So this is probably a very good strategy for some people. The last strategy I want to mention is the use of self-directed IRA to invest in crypto. This strategy is becoming more and more popular. I actually used it myself for my own crypto investment. Because investment returns in retirement accounts are tax deferred, you can save a lot of crypto taxes by investing with a self-directed IRA account rather than a regular crypto investment account. Now, we all know that IRA has different types. And when compare Roth IRA with the traditional tax-deductible IRA, I would say if you believe your crypto value, asset value, will increase substantially over time in the future, using a self-directed Roth IRA to invest in crypto is probably a better choice than using a traditional IRA account because earnings in Roth IRA is tax-free for qualified distributions. One thing I do want to caution everybody is be aware of prohibited transactions for IRA accounts. For example, investing in collectibles is not allowed for retirement accounts. So I would stay away from using my IRA account to invest in art-based NFTs because they may be classified as collectible. So choosing your investment carefully. All right. Okay, so the next strategy or next round of strategy is called going the extra mile. Go the extra mile tax saving plan. All right. For people who want to do this, go the extra mile to minimize their crypto taxes, they can move. Okay. So move to a place that offers a lower tax rate than their current jurisdiction. For example, they can move to a low or no tax state, such as Arkansas, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, or Wyoming. Those are the, I think, 9 states famous for no income tax. Just be mindful of the different requirements for establishing domicile in different states. We have some clients who tried to use the strategy and they kind of moved to a no tax state, but they cannot cut ties with their original state. Like I remember one client, he was living in California. And then he said, okay, I'm going to move to Texas. I have my parents live there. But he only just like moved there for a certain period of time. And then he still maintains a home in California. So we told him, no, I don't think you can say you are no longer a California resident because you still own a home there. And then he's like, well, I stay at my parents' house in Texas most of the time. I'm renting out my home to someone else. But still, I think most likely California is going to go after you for state tax. So be very careful. If you want to move, you have to actually do it, and you have to cut your ties with your original home state. Truly move everything to the new place. Another thing is, even if a state has no income tax, they may have other kinds of taxes you need to consider. So for example, I believe Washington State or maybe even Wyoming, even though they don't have income tax, they have, I think they do tax like capital gains and or investment income. Now, if you want to go even more further, you can move to a crypto-friendly or low-tax country. Some examples of crypto-friendly countries include El Salvador, Singapore, Slovenia, Portugal, Switzerland, Germany, Malta, Estonia, the Netherlands, and Canada. Now, one thing we need to remember is you cannot just like escape to a different country and then think that, oh, I don't need to pay US tax anymore. Because US has a worldwide tax system. If you are a US resident or citizen, even after you move to another country, you still need to pay US tax for your income and capital gain because of the worldwide tax regime. Although you may be able to claim a foreign tax credit or foreign earned income exclusion to reduce your taxes. But you are not like totally safe from paying US tax by just moving to a different country. All right. How about moving to Puerto Rico, right? That has been a hot topic in the crypto community for several years now. We get clients or prospects asking us, hey, I'm thinking about moving to Puerto Rico, so I don't need to pay any crypto taxes, right? Well, it really depends. Okay, so unlike moving to a foreign country, Puerto Rico residents are not subject to US taxes for income and capital gains sourced. Okay, that's the key. Sourced in Puerto Rico. Because Puerto Rico is a US territory, not a foreign country. If you plan to move to Puerto Rico, or your client plans to move to Puerto Rico, they need to keep in mind that they are still required to pay U.S. tax for income sourced outside of Puerto Rico, even after they move to Puerto Rico. All right. Also, they cannot avoid paying U.S. tax for at least part of the capital gains related to investment assets such as crypto that they purchased in the US before their relocation. What I mean is, let's say you bought crypto for $10,000, and then now the price has increased so much, it's now worth 100K. And so you say, okay, I'm going to just move to Puerto Rico. Then I'm going to sell the crypto in Puerto Rico, and I don't need to pay anything, right? I don't need to pay taxes, right? Because Puerto Rico does have a favorite tax system. For example, they offer 0% tax on crypto earnings, including capital gains from trades and income from staking and mining, etc., for individuals. But if you bought the asset in the US, not in Puerto Rico, and then you sell it in Puerto Rico, at least part of that gain is subject to US tax. ACT Act 60, originally Act 22 of Puerto Rico, offers these tax benefits to Puerto Rico residents who meet certain specific requirements or criteria. It's not like once you move to Puerto Rico, you can just enjoy the tax benefits automatically and immediately. That's not the case. We usually recommend our clients who are thinking about moving to Puerto Rico to consult a tax advisor who is knowledgeable about Puerto Rico tax law, or even visit Puerto Rico and talk to a tax advisor there to make sure they get the full picture about everything before they just pack up and move. One thing is not really tax related, and I have been talking to my clients or prospects that who came to me, is this is the life-changing event. You should not only look at the tax consequence, because you really have to move. You have to uproot everything in the state and move to a totally different environment. You need to leave probably most of your family, friends, and family relatives behind, unless they are moving with you. And then you have to probably find a new job. You know, if you have kids, your kids will need to go to a new school, or maybe even learn a new language and all the things like that. So there are a lot to consider before making a decision to move. Sorry, click too soon. All right, let's talk about whether using business entity structure for crypto investment is a good tax planning strategy or not. From time to time, we got people coming to us and saying that their CPA or their friend told them to do their crypto investment with an S corp. So is S corp really the magic bullet? I would say not really. Why? Because S corp is a pass-through entity, and investment income is not subject to self-employment tax, as you know. There's really no tax saving for doing investment in crypto when you compare doing it personally or by using an S corp. In addition, using S corp for crypto investment will most likely incur more costs, such as you have to do bookkeeping, you have to file a business tax return for the S corp, things like that, which will outweigh any benefit you may get. But how about using single member LLC? That's also another popular so-called strategy by some crypto investors. Well, it's pretty much the same situation as for S corps. Although the compliance cost for single member LLC is probably lower because you don't need to file a separate business tax return and do bookkeeping, all the things like that. You probably only just need to file a Schedule C with your 1040. But please note that usually investors cannot use single member LLC to deduct investment expense as business expense. Because as we know, at this point, investment expense is no longer deductible. But if you turn it into business expense, of course, you can deduct it, right? But you have to look at whether truly the nature of your expense, whether it's truly a business expense or it's just the way that you're trying to use to get a deduction. One thing about single member LLC is they do offer some kind of legal protection for your crypto assets. If you are using it, you're putting all your crypto assets in an account that is under the name of an LLC versus purely under your personal name. So some people may want to do that even without tax benefit. They may still want to go ahead and do it so that they can kind of like shield it to protect it from like potential risks down the road for legal purposes. Now, for full-time or professional traders, sometimes it does, you actually not sometimes, I should say usually it does make sense for them to form a business entity to handle their crypto investments. And there's a thing called trader tax status. If you qualify for that, you can enjoy some tax benefits that are not available to regular investors. Now, to qualify for trader tax status, you need to meet certain requirements, such as you need to be a full-time or a heavy trader. You trade frequently and regularly, usually on a daily basis, and continuously with a significant amount of investment. Also, your goal needs to be profiting from day trading or swing trades, and you need to intend to trade as a business. So those are the factors you need to consider if you want to qualify for the trader tax status. Some benefits of having a trader tax status include the ability to claim business expense treatment for education related to crypto investment, home office expenses, margin interest, investment fees, etc. So once you establish that you qualify for trader tax status, those expenses, they are considered business expense. In addition, those traders can utilize Section 475 mark-to-market election to deduct their trading losses as ordinary rather than capital losses, which means they are not subject to the annual $3,000 net capital loss deduction limit Of course, one downside of mark-to-market election is if the fair market value of your crypto assets at the end of year is higher than your cost basis, you will need to recognize ordinary income for the increase in value. So in this case, you are going to have to pay taxes on income, ordinary income, even if you didn't sell the assets. That's how mark-to-market works. Also, once you make the election, you have to apply. If you want to revoke, want to get out of it, you need to submit an application to the IRS. It's not like you just automatically, you can just stop it anytime you want. Now, if you qualify for trader tax status and you make an S-Corp election for your business, you can unlock additional tax deductions such as health and retirement benefits. So in this case, it does make sense to use S-Corp for your crypto investment. All right, so I think I go a little bit too fast, but that's okay. I can share a lot more about this slide. I think this is something that will be helpful, I hope, for tax practitioners. So here are some tips for doing tax planning for your crypto investor clients. First, to be able to do effective tax planning for your crypto clients, you need to be knowledgeable about all the crypto tax rules and regulations. So there are some things about crypto that are not the same as for traditional investment. So if you don't know those rules, then you will not be able to advise your clients and come up with a effective, a good tax planning strategy for them. So it is critical for tax practitioners to learn and truly understand all the crypto tax rules. So get yourself familiar with that. And there are many ways to achieve that. There are some, I would recommend, like, just go to the IRS website, type in digital asset in the search box, and you will see a page specifically for digital assets, which is cryptocurrency. It has a list of resources, rules, things like that are published by the IRS. I would say that is the first place to go if you are not yet familiar with crypto regulations, crypto tax rules. And also there are other resources, including AICPA, some big four. I think they also published a lot of crypto tax related articles, rules, and things like that. And a lot of free resources, actually, you can search the internet and get. So there's no reason for you not to be able to to find those resources. It's pretty much like everywhere. So I would highly recommend that you become very knowledgeable about crypto tax rules and regulations before you can advise your client or do any tax planning for them. Also, it's very important for you to be able to so-called speak the crypto language. All right, what it means is when your clients, crypto clients, are talking to you about their situation, their investments, you need to be able to understand them and be able to respond in their crypto language. When they are talking about like, oh yeah, I got this DeFi liquidity pool, and then I'm doing this self-paying loan and things like that. Well, first of all, you need to be able to understand what they are talking about. So I have prospects coming to me a lot of time. They're like, yeah, I was talking to my CPA who I used for, more than 10 years, that I got into crypto, and I'm doing a lot of different activities. And when I mentioned about, I asked him, what's the tax treatment for airdrop? And then he's like, what is airdrop? So that is not good, right? When you have this situation, I can tell you your client's confidence just dropped right away. So make sure you understand what they are talking about, and you can respond accordingly. Even if you understand what they are talking about, but if you cannot respond back, you still look not competent in their eyes. So that's something very important. I would say one way to achieve this competency is to study and get yourself familiar with how crypto transactions work. And even better, to try to invest in crypto a little bit. Even if you don't want to become a crypto investor, it's very easy to just learn how it works by just do a little bit. So I know crypto CFOs has this pretty amazing, I took it myself. It's a 3-hour CPU course. I think it's called the crypto universe or something like that. I forgot the name. I apologize for that. But it walks you through like how to set up use your Coinbase account and fund it, and then how to buy crypto with USD, and then you set up a wallet, a MetaMask wallet, and then transfer the crypto from Coinbase there, and then use it to get into a little bit of DeFi, and even buy a NFT, which is actually created by crypto CFOs. It's really cool. I really like that NFT. Looks really cool. So after going through that, and then they also teach you how to download all the transactions and reconcile them, and how to calculate your gain or loss from those different activities. So it's a very good course. I would highly recommend if you are new or relatively, new to crypto, you have not done any crypto transactions yourself, please consider taking that course. It's very helpful to understand how crypto transactions work. You need to have first-hand in-person experience in order to truly understand. I would caution, not just based on reading. Some people thought they portray themselves as an expert. I have seen situations like that by just reading, and then they say, yeah, I know everything. And when we ask them, have you actually invest in crypto? No, I have never touched crypto before because I don't believe in crypto. And they're like, okay, this is like a contradiction, right? So be careful. Okay, so make sure that you truly know by doing it. And another thing that I believe is critical is, in order to do tax planning for clients, you need to make sure their transactions, crypto transactions, are fully reconciled so that you can review and you can provide tax planning advice accordingly. Because if their transactions are not fully reconciled, then you don't really know the correct situation. I mean, the real situation, whether they are having some losses, unrealized losses, or they are in a gain situation, then there's no way for you to correctly come up with tax planning strategy for them to use. For our firm, we have a standard procedure at the end of every crypto account reconciliation project to generate different versions of tax report by using different cost basis allocation method in the crypto tax software that we use, to compare the results and see which allocation method is the best option for the client. This is an important tax planning step. I would highly recommend that all tax practitioners consider using, because this is like such an easy way of providing high value tax planning a result for your clients without having to do any additional work. Another thing you should consider doing to help with effective tax planning is to understand each client's investment and tax saving goals. Because there's no one size fits all when it comes to tax planning. Everybody's situation is different. So you cannot say, okay, this is the best planning strategy. I'm going to just tell all my clients to use it. All right. Because some clients, they may want to utilize more losses because they have capital gains from their, for example, stock investment. Even though earlier we said you may not want to just maximize your capital losses because there is a $3,000 net loss limit each year. But if the client has a lot of gains from other investment, maybe they want to maximize their capital loss from crypto. So you have to look at the situation. We also need to keep in mind that crypto is only part of every client's overall tax situation. All right, it's not 100%. There are many other things we need to consider that go into the tax return. So we cannot only look at crypto alone to advise our clients what to do. We need to do a comprehensive tax planning by considering all the relevant factors. One last advice I want to give is to do tax planning proactively and timely. Also, to educate your clients about the importance of this. We often have clients or prospects coming to us and ask us to help them with tax planning after the fact, meaning when the event is already happening or even over. So I still remember in several cases, they're like, yeah, I sold crypto for, and I think now I'm sitting at like a $3 million gain in total. What tax planning can I do to not pay tax on it? Right? That's after a year already ended. They're about to file their tax return. So I'm like, I don't think there's much you can, or anything at all you can do, right? Because it's too late. So the bottom line is tax planning must be done in advance, just like planning for everything. That's why it's called planning, right? Planning has to plan ahead.